FreshPet is a fast-growing company in an industry that's attractive because of this trend I've been seeing, the humanization of pets, where people are treating their pets more like humans, more like part of the family, and that's creating a nice tailwind for the industry overall. In this video, I'm going to share with you the biggest risks that FreshPet faces. Then I'll share with you my proprietary discounted cash flow valuation of the company that calculates what I think is a fair value of the stock price today. And then I'll also look at valuation on a forward price to earnings perspective to give us another perspective on valuation. I'll bring it all together and answer the question if I think this stock is a buy right now, which the market price is trading near its 52-week low.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the biggest risks right now have to do with its supply chain and production vulnerabilities. Of course, increases in the cost of ingredients or packaging materials can adversely affect the company's condition and results of operations. And since the implementation of the tariffs on the United States trading partners, the supply chain worldwide is going through some major volatility. There's going to be a lot of movement. There's going to be a lot of shortages. There's going to be a lot of overages. There's going to be some volatility, and businesses, especially smaller businesses like FreshPet, are going to face bigger challenges in the near term adjusting to these major changes. So there's going to be perhaps some limitations in production capacity, which can hinder its ability to meet growing demand. And it can impact customer satisfaction if a company like FreshPet is unable to get the required production capacity to meet consumer demand. And then a bigger company can step in and fill that consumer demand. They can have a harder time growing. So maintaining consistent product quality is also critical. They could have some difficulty in the near term as the supply chain is disrupted in meeting consistent product quality if they have to change suppliers, for instance, because of the changes in manufacturing. That could be an issue as well. Right, the next set of risks I'll highlight are regulatory and environmental compliance. The company is subject to environmental regulation and risks, which might affect its business if it doesn't meet those standards. Food safety is a big one. Compliance with food safety standards is essential. Any violations can result in penalties and loss of consumer trust. And these are very common with these food companies. It's difficult to not make an error. It's difficult to not have some impact and have your consumers lose trust because of something that happened. It's just inevitable as part of doing business that there's going to be some issues. And once those issues become public, you might lose trust with your consumers. So those are some of the biggest risks that the company faces in the near term and in the long term. Right. So now that I've shared with you the risks for FreshPet, I wanted to share with you my proprietary discounted cash flow valuation model, which calculates a fair value of a stock, what I think the business is worth today. Now, I'm not going to go through a detailed breakdown of this discounted cash flow valuation model. I do that in separate videos. If you like that type of detailed breakdown, I have dozens and dozens of those available as member exclusive videos. You can join my channel for less than $5 a month and you'll get access to those as well as more very interesting, very informative videos. So in this video, I'll focus on the outcome of the calculation. And for FreshPet, I calculated the intrinsic value, what I think the stock price is worth today, at $52.10. Now, that's still well below the current market price of $78.71, which might surprise some of you because it's trading near its 52-week low. So you might think, well, it's undervalued, right? It's trading near the 52-week low. The 52-week low was $71, so it's roughly 10% away from its 52-week low. The high in the last year was $164, so it's down by more than half from its 52-week high. So this just goes to demonstrate how price action doesn't necessarily determine if a stock is undervalued or overvalued. I look at what the company is expected to earn in terms of cash flow for the very long run to determine if I think the stock is undervalued. And sometimes I find stocks to be undervalued even though they're near all-time highs. And sometimes I find stocks to be overvalued even though they're near their all-time lows. And so this is an example of one scenario of something similar where stock is near its 52-week low, but I still feel like it's overvalued because when I calculate the present value of all of the free cash flow I expect this company to generate between today and the very long run, it still looks overvalued at the current market price. So that's just one perspective, right? My discounted cash flow valuation model, I could have made mistakes in the estimates and assumptions to make that calculation. So I like to look at other valuation metrics as well to give me more perspective on the valuation of the company. And I like to go to finchat.io to get the forward price to earnings ratio. There's a link in the description for a discount. The forward price to earnings for FreshPet is 55. It's near the lower end of where it's traded for according to this metric. Going back to, I want to say mid 2024, it used to trade at forward price to earnings of closer to 200. It's a fast growing company, as I mentioned. The company's free cash flow is expected to grow robustly over the next decade. And when businesses are growing so quickly, their valuations are generally more expensive. And you see that here with FreshPet trading at a forward price to earnings of 55. And I would say the forward PE for a company that's growing this quickly at 55, I would say this shows that the business is fairly valued on the forward PE metric, whereas with my discounted cash flow, it looked overvalued. And so to bring it all together and to answer the question, do I think the stock is a buy, hold, or a sell? I rated the company as a hold, and I updated that recommendation on May 14th, 2025. It has some good prospects for the long term, but the valuation is a little bit too rich for me to get into this company at the current market price.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.